We'll share.
We'll share. All right, we are live. I'm Jack Farley, joined as always by former senior trader for the Federal Reserve, Joseph Wang, aka Fed Guy, and we have a special guest. Joseph, how about you tell the audience about our special guest?
So this guy is one of the best money market analysts on FinTwit. And you guys, if you don't follow him already, you must follow him. Some great insight of what's happening in money markets and in banking. And this guy, he's anonymous, but we see who he is. He is the great analyst DC here. Um, Say hi.
Thank you guys. Yeah, thanks a
Yeah.
lot for the
So
intro and thanks for accommodating me as an anon guest. I don't know if you've had any before, but I really appreciate it.
It's our first, and we're glad to do it. DC, could you quickly tell the audience, without revealing who you are, a little bit about your background and how you gained familiarity with these abstruse topics?
So I guess quick rundown. I've been kind of without going into too much detail, I've been in the fixed income markets for a while, first as a hedge fund credit analyst, and then more in the private credit world, which is kind of where I am right now. And really how I became interested in kind of these money markets and rates topics is, well, really through my work and people I know, but also joining FinTwit and talking to people like Joseph. And there's just a great community here, and people really try to help each other out and try to learn as much as possible. So I'm learning. I'm also posting, and I'm happy to share what I've learned so far with you guys.
And just so you guys know, DC also has a Substack that he updates sometimes, and there's a lot of good information on it, just teaching you about money markets and how some of the financial system works. So if you guys who haven't seen it before, definitely check it out.
Yes, definitely. We'll put a link in that description. DC, the first topic I want to ask you is why are banks buying fewer treasuries? They've bought a lot of them since QE started in 2020, or the next level of QE, but now they're sort of slowing down their pace of buying both treasuries and mortgage-backed securities. What was it that made you first notice it? Why is it significant, and how do you think it's going to play out?
Well, I mean, there was a big mechanical factor that was really causing banks to buy treasuries throughout the past 2 years or so, and that was simply the fact that their balance sheet was growing so much, and that was coming, well, primarily from fiscal spending from the Treasury. The Treasury spent out checks, added reserves to one side of the bank's balance sheet, and added deposits to the other side. Now, deposit rates were basically at zero, and so was the interest rate on reserves up until very recently. So for the banks, really at the basic level, that transaction was just taking up space on their balance sheet. Really, it wasn't, there was no yield on either side. So they wanted to do something. If they wanted to make money, they would have to buy some assets, and well, those assets can be loans that they can make, or they can be other securities. But really, over the past 2 years, they were, or not entirely, but a large fraction of them were very safe securities, so U.S. Treasuries and government agency securities. So that played out over kind of the last 2 years or so, really, from March 2020 to more or less present. But now, since the fiscal impulse is gone and the rapid growth really on both sides of the bank's balance sheet is gone, there's not as much momentum there anymore. Like, some of the smaller banks are still buying treasuries, but not really very much, and the large banks not really at all. So that is mostly faded away now.
So I'm going to put up a chart that you flagged. Tell us what we're seeing here, and then I want Joseph to weigh in.
Yeah, so this is just the monthly changes. So the blue bars are Treasury securities of all commercial banks in the U.S. data set, and the red bars are mortgage-backed agency securities. So and that's very much the effect that we talked about there. So, and there was some volatility at the start of the pandemic when it just hit in March of 2020, and then from there on out, you saw the banks very consistently, basically every single month, adding Treasury and agency securities as the cash came in. But towards kind of heading into 22, that has now come down to pretty much normal levels.
Yeah, I think something just to keep in mind in the background, and DC mentioned this, is that so a bank at a very high level, it's kind of like a supermarket in the sense that it only has so much store shelf, and you think of that what they call that balance sheet, uh, basically balance sheet space, and so for a given amount of capital or let's say equity, so they can only hold so much stuff, so they have so much shelf space. Now, when the Fed and Treasury are working together, they're filling their shelf space with a lot of cash, which is low yielding. And as DC mentioned, what they're basically doing is they're trying to upgrade that cash to something that's yielding a little bit higher, but also high quality, so it stays within their regulations. So they're basically swap out of cash with comparatively high quality securities like Treasuries and uh, agency MBS, which is slightly less, but about the same. And you saw them do that the whole basically post-COVID, and a lot of people wonder who are all these people buying treasuries, and it was the commercial banks that emerged as a marginal buyer in the post-COVID world. You see that most obviously in the big GSIBs, and DC has flagged this before. If you look at their press conferences, they'll tell you Bank of America, for example, cash flows in, we buy securities until, of course, the past quarter.
And why has that changed? Either of you can take this one. Why has that changed, and to what degree does that have to do with monetary tightening, either quantitative tightening the balance sheet or raising rates?
Yeah, so kind of the most direct reason why that's changed is deposits are simply not growing that much anymore. If you kind of look at the even the most recent bank numbers that are coming out this week, you look at deposit growth from Q4 of 2021, and there's a little bit, but it's very marginal. So really, they one of the reasons is they have no more cash that they readily want to deploy into treasuries. And part of the other reason is that loan demand has started to come back a little bit in kind of gradually, but rising. So the banks, some of the banks at least, have found that is a better place, that is a better yield to deploy their cash than to just buy securities, right?
Yeah, I think the past week, Bank of America has basically said the same thing, and JPM has some macro view about rates going higher, but basically loan demand has been going higher, and like DC mentioned, so I mean, if you're a bank and you have so much shelf space, so much balance sheet, you want to be able to optimize it to have higher yielding assets, right? So, sure, securities are better than cash at the Fed, but even better is to have loans, and looks like there's loan demand now, like so going forward, banks might not be as big a purchaser in treasuries as they were before.
Which leads to our next topic, which is how this period of quantitative tightening is going to be different than previous ones. DC, I know you have a specific view that if and when cracks start to form because of this instance of the Fed's reducing its balance sheet, it will be very different than the quantitative tightening of 2018. Can you explain what you meant by that?
Yeah, so really what has happened, and this has happened kind of in multiple stages, kind of going back to even the pre-08 crisis era, is that the amount of outside money within the system has grown, and the reach of the Fed in through which it can deploy this outside money to fix emerging problems in the system has also grown. So before 2008, the system was growing really rapidly. The world was globalizing and GDP was growing, but there was relatively little outside money in that, in terms of money liabilities of the Federal Reserve. Reserve balances were very low, around a few dozen billion, right? And most of what really functioned as money in the system there was inside money, was intra-system money. And as we turned the cycle through the 08 crisis into 2018, the Fed grew the balance sheet and also extended some tools to backstop some of the funding markets. But repo specifically was still somewhat outside of the reach of the Federal Reserve. And we saw that during 2019, as the Fed needed to intervene into the intradealer repo market to stop repo rates from spiking in September. But as the 2020 crisis also passed, the system took kind of a further evolutionary step. And now there's even more risk-free money within the system. The Fed's balance sheet is even bigger, and the Fed has even more reach. So it has the standing repo facility, it has the FEMA repos, the standing FX swaps. So it has much more guardrails in terms of the overnight market, especially onshore in the U.S., to some degree also offshore through the foreign central banks. But the guardrails in terms of the repo market are just much stronger right now, and the liquidity at the banks is also a lot higher than it was in 2018. So as that starts tapering off, what we might see is, well, we'll see financial conditions tighten, and we might see things get a little bit more tough in peripheral markets. But in terms of the kind of core of the overnight funding market within the U.S. system, the Fed has just much more control over that than it did even a few years ago, right?
DC, you're talking about the new standing repo facility, right?
Mm-hmm.
Yeah, so for you guys who don't know, the Fed has this new standing repo facility that's basically willing to lend basically unlimited amounts of money into the repo market through the primary dealers. I think in theory the limit is like $500 billion, but that's the way that the Fed does things is they don't want to ever say unlimited. They just pick a really big number. And if it really gets close to a really big number, they will pick even bigger number. That's what happened with the RRP. I think it was 30 and then 60, and now it's like a really big number. So
1.7 trillion.
always assume that these are unlimited numbers. So
right, there we
if
go.
you don't,
Go ahead.
so if you don't think that the repo market, the plumbing is so for you guys who are following along at home, what DC first of all channeled the framework by Perry Merling and Zoltan Poster of inside outside money, and was thinking first of all in the pre-financial world, pre-GFC world, there was a lot of money that was basically interbank, so banks lending to each other. Post GFC, that's not the case anymore. So banks don't lend to each other as much, and so that there's more dependent upon outside money. So dependent upon things like money market funds and now the Fed as a supporter to that interbank interdealer system. But if that's totally safe, what should we be worried about when it comes to QT going forward?
So things that markets that would be affected, right?
Yeah.
So I mean, most directly, you have the kind of peripheral funding markets, right? So that would be kind of FX swaps, commercial paper, LIBOR, really, which is kind of based off of those to some extent, since it's all the same banks really funding in those markets. And those would probably widen. But I mean, really, the question comes down to, right, is and this was what happened in March of 2020 also was the Treasury markets, is can we maintain the kind of orderly trading of Treasury coupons as QT shrinks reserves, and also as Treasury issuance remains fairly high. And I know, Joseph, you have views on this, so yeah.
Yeah. No, so I get the sense that we probably have some similar view on this, and that the fragility really is probably in the Treasury market. If you really think about it, I mean, it's a market that grows by literally over $1 trillion every year. That's just insane. There's no way there's enough liquidity that can scale in proportion to that issuance. So that I think that itself implies fragility. You don't really see it unless there's some kind of panic. Then you see it very clearly, like you did in March 2020. I mean, if you just look at just the amount of daily cash Treasury trading and with reference to outstanding, that it's not scaling anywhere near the same proportion. Outstanding is growing like over the past 20 years by 7 times. Cash trading has only grown by less than double. So when people want to sell, there's just so much out there that there's no way the market can hold that. And there's a lot of other factors too that seem to suggest fragility. I mean, for the people who care about things like inflation, for example, it looks like it might be structurally higher.
And
we have a go ahead.
Oh, actually, question there. So I know we were talking before we went live about the BOJ and about their yield curve. And do you think if such an event were to happen, it could be a test of the U.S. Treasury market in the post 2020 era? to see if it can withstand those kind of shocks, right?
Yeah. So I saw your post today, or maybe yesterday, about just the BOJ. What happens if they would let go of the yield curve control? So as we all know, uh, yields throughout the world are going higher. The BOJ is resisting that. That makes the interest differential between Japan and outside of the US or the Eurozone ever wider. And so that's leading to a massive, massive implosion of the Japanese yen. I mean, it's basically going parabolic. And eventually, you know, the BOJ is going to be like, that's enough. I think I have enough depreciation. Maybe I'll get my inflation that I finally want. Okay, they're going to have to stop that. The way to stop that, of course, is to let their yields um, go higher a little bit so that the interest rate gap is not as large. They're going to have to reevaluate yield curve control. And let's say they go by 25 basis points to 50. That sounds reasonable, right? So when that happens, though, because the global bond market it's all connected together, that discrete jump in 25 basis points, it's going to pass throughout the global bond markets, and that's going to be a pretty big shock, especially when you have, you know, already yields are very low. Not just okay, so the U.S. is okay, but look, think about the eurozone. A lot of Japanese investors actually buy, like, say, French oats and buns, and so they're going to be evaluating between these higher level JGBs and whatever they're offering in the eurozone. That might feed through, and that's going to be a big loss for them because their yields are already so low. You mean the duration is very high, so I think that will be a very big shock for the global bond markets, including the treasury markets. I think it could potentially be disorderly. I mean, that would be a very big discrete move. So I think that's definitely something that we should think about in the future because the yen can't go on like this forever, right? So eventually, the BOJ is going to have to call quits, and so we have some kind of yield shock, maybe in the near future. I don't know. What do you think the BOJ is shooting for? Do you think 130, 135, 150, or maybe they just don't know?
Yeah, I mean, to some extent, you also think that that it has to do with the speed of the move. If let's say USD yen were to stay at 130 steady from here on out, the BOJ could probably live with that. But the speed at which we've gotten from 110 to 130 is that might make them panic, right? Or, well, not panic, but feel like they need to do something.
So, what could they do? I mean, they could talk it down for sure, but unless they're willing to, let's say, be a little bit more flexible about their yield curve control, it doesn't seem like the market would care. I mean, I'm seeing headlines saying about, the officials at the Ministry of Finance there noticing this, but, it doesn't seem to be working. And the way that the momentum is building, it seems like we're accelerating. And, there's a whole bunch of people, retail and institutional momentum changers who are just going to push this until it goes to the moon. And so, yeah, when so much leverage builds, it's probably going to be disorderly when it stops. But do you think that like 135, 140, 150, 130? Do you think they have a goal?
I've heard 130 mentioned as kind of
Yeah.
a line in the sand, but that's the market's guess, right? And some people in the market are saying 130. Maybe some people in the market are saying 135. But you have to think if the move keeps moving as quickly as it has been, they're going to have to do something sooner rather than later, right?
Yeah. The speed definitely would be very disorderly, but I just don't know what they can do to make it slow down. I mean, could Kuroda just say at this next meeting, we like depreciation, but can you do it slower? Yeah.
Yeah.
Maybe they'll have a Bank of Japan governor be very extra devilish. And they say we need 160, sort of a Bullard type.
Yeah, that'll be crazy, really.
Joseph, CG in the comments asked, who is going to buy all of these treasuries? And that's a great question because how much does the Fed have to reduce its balance sheet by? 2 trillion, 3 trillion? There's a lot of treasuries that it has to make disappear, and a lot of mortgage-backed securities. And that's mortgage-backed securities have its own problem that we're going to get to later. But just who's going to buy all those treasuries? There's money market funds, where, Joseph, you have a lot of expertise. There's hedge funds. There's households. There's banks. There's the Treasury, which has to issue more in order to refinance its debt. But I think we have a real treat for the audience because DC on Twitter you flag. And by the way, I just want to say everyone should follow Analyst DC on Twitter. He's a great follow. And while they're at it, they should subscribe to the Blockworks YouTube channel so you can get more videos just like this. But DC, you flagged a paper by the blog for the New York Fed, Liberty Street Economics, where they outlined a series of scenarios about what the Fed's balance sheet normally looks like, and then what it looks like if the banks were to buy them, what it looks like if the money markets were to buy them. And can you just walk us through that scenario? Because I made a few screenshots so we can look at them.
Yeah, sure. And I would highly recommend people go and read the blogs. The blog posts, they're not very long and they're quite informative to kind of think how the Fed thinks about this. But really the fundamentally it's an arithmetic problem, right? The Fed is a bank and it has a balance sheet and the two sides need to match up, right? So if the Fed reduces the assets on one side, it also reduces the liabilities on the other side by the same amount. And the liabilities are made up of liabilities to commercial banks and liabilities to money market funds. So it's kind of there's a bit of uncertainty there exactly where the reduction is going to come from, but just by the balance sheet arithmetic, either money market fund liabilities or liabilities to banks must be reduced. So yeah, these are the charts, right?
Yep, and MMF is money market fund. So this is the initial conditions. This is what happens during the Fed's balance sheet roll off. It's not selling securities, it's just letting them expire or roll off. So minus $1 in terms of an asset for its assets, but it also has one fewer of its liability because, well, Joseph, how about you save me? Tell us what's going on here.
So actually, the two blog posts mentioned by DC, check them out. They were written by my former colleagues on the Open Markets desk. So I think on a high level, what you can think about is that so the Fed has a whole bunch of treasuries, and they're going to roll off. So what's going to happen? How the Treasury is going to have to repay the Fed. Now, how does the Treasury going to do that? The way the Treasury is going to do that is it's going to issue new Treasury securities to the private sector and then take that money and repay the Fed. And who ultimately ends up buying those newly issued treasuries in large part determines on what kind of treasuries the U.S. Treasury Department will issue. This is really important because treasuries come in different types and each type has a different investor base. If you issue short-term treasuries, treasury bills, basically treasuries that mature within a year, it's largely money market funds, like the MMFs on the lower right side. Or if you issue longer dated, let's say coupons, 10s, 20s, 30s, that's a different investor base altogether. And so the U.S. Treasury is going to have to decide how they're going to issue. I think if we issue in the money market space, issue treasury bills, I think basically the money market funds will gobble them all up, right?
Right. So just so people can see on the upper right hand, now it says cash held at the Fed minus $1 for the treasuries. That's a problem. So all of the following scenarios you're going to see are a solution to the problem that the Treasury doesn't have any money. So let's see. This is if the banks buy them. DC, do you feel comfortable running us through this?
Yeah, sure. So if the banks buy the treasuries, that means the banks have a checking account with the Fed, which is their reserve account, and they spend money out of that at either a treasury auction or buying them on the open market, and then the cash in their checking account goes down. They have a treasury on their balance sheet now, and the Treasury gets the money that it needs to repay the Fed.
Right. So the size of the commercial bank balance sheet does not change, but the composition does. It has a greater percentage of treasuries and a fewer percentage of reserves. And now the next one is if money markets purchase treasuries. All right, Joseph, you're the resident money market expert. So you gotta.
This is what I was just saying. So basically, the money market fund takes money out of looks like here out of the RRP and uses to buy treasuries. So the money goes out of the RRP into the U.S. Treasury's checking account, and then the U.S. Treasury takes that money and sends it to the Fed, which gets canceled, right? So at the end of the day, the Fed's balance sheet shrinks because it doesn't have fewer own RRP liabilities and no more treasuries. But the private sector holds more treasury security liabilities. So treasuries assets for the private sector, liabilities for the U.S. Treasury. It's at the end of the day, basically, someone steps in the Fed's place and holds those treasuries. Someone in the non-Fed. You can think of it as private sector, but it's also possible that foreign official accounts, like a foreign reserve manager, holds it. So it's not strictly speaking uh, private sector, but someone that's not the Fed is going to have to hold over the next 3 years $3 trillion more in Treasury securities because that's the target of the Fed. It seems like they're targeting a $3 trillion in QT. So that's a lot of treasuries that someone that's not the Fed is going to have to hold. And the question is, what price are they going to have to hold it at? And can they do it in an orderly way?
What do you think, Joseph?
Yeah. So the in the post COVID world, like DC was showing, that it was the commercial banks gobbling up a lot of that issuance, and now we're just ending bank earning calls, and you just had Chris Whalen on a great show. Banks are saying that they're not really interested in buying these securities anymore. They're interested in making loans. So banks seem to be out of the picture. So okay, who's next? Now I'm just assuming that it's not all going to be in T-bills, because if it is, then money market funds will gobble it up. Now, if you look past them, I think the next group of people that are big holders of treasuries are foreigners, and that's divided into foreign officials, so central reserve managers, like let's say the PBOC, or private sector foreign investors, let's say Japanese life insurers. But there are two things that are happening that are making it, I think, in my view, that they probably won't step up. One is that, well, we saw the U.S. confiscate Russian reserves. So, if you're a foreign reserve manager, maybe you don't want to hold all your money into treasuries. That's not safe. And the second thing that's happening is that the Fed is raising short-term interest rates. So if you're like a life insurer and you're buying treasuries, you have to hedge the FX changes a little bit. And the way you hedge that is you use the FX swaps, where rates are based on money market rates. So that's going to be really expensive. So your FX hedge value of treasuries, FX hedge return, is going to be really low going forward. So maybe it's not that attractive to you. So you have new buyers. It just seems, in my view, that they're going to need a lot higher return. Do you see what do you think?
Yeah, I mean, I mainly agree with that view, and that there are buyers. Bonds will always find buyers at a high enough yield. It's kind of a big property of bonds. If people don't like them, the yields go up. Um, yeah, at this level, it's hard to say that there is a real money bid. If you've been looking at the bond market lately over the past few weeks, they've been going down and down and down, and really kind of all signs of strength have been faded. So the one wild card that I see is the relative value community. So relative value hedge funds do take down a portion of treasury issuance, and they did a lot more of that in 2018, 2019, and they fund themselves in the repo market, and they go out and they buy treasuries on leverage to arbitrage relative value spreads that they can find, right? So especially with kind of sponsored repo growing a lot in the repo market now, these hedge funds can get funding from the money market funds. They can drain cash from the RRP, and I think it's a big wild card how much relative value activity we're going to see. But besides that, I would agree. Yeah, like treasuries will find buyers at higher yields, but those yields are that they haven't shown up yet, at least.
That's a really good point. So, the Fed actually has a special data series that shows like treasury holdings of hedge funds. It's based on form PF, which is like a super confidential form that very, very few people see. And from, I think, pre and post COVID, the hedge fund community, I think, took down their treasury exposure by almost like $1 trillion. So they definitely shrink away from that relative value trade. And I mean, obviously, probably went broke in March 2020, so that obviously hurt. And so that does show that there's capacity for them to get back in, and especially since rate vol is high, there might be more dislocations. And for those of you at home who are not familiar, what happens in these basis trades is that, let's say, a hedge fund will sell treasury futures and buy a cash treasury funded by repo, and then they would deliver that cash treasury into the futures contract to harvest the dislocation. So because they're doing that trade, they're buying cash treasuries funded in repo, as DC mentioned. The only thing that I would note about that is that there is some capacity. The repo has a certain capacity limit, and sponsored repo widens that a bit. But if you look at the data, it seems like it's not as widely used in the buy side community, not just yet, but so if you have so much issuance, the levered community, I think, can definitely take out, in theory, a large chunk, but there's a limit to that based on balance sheet constraints, and it's not clear just if they'll hit it or not. So I guess we'll find out in the coming months.
Yeah.
So Joseph and DC, your thesis, it sounds like the Federal Reserve is going to have to release trillions of dollars of treasuries from its balance sheet, and who's going to have to handle that? Well, banks are shrinking their balance sheets at the same time, so they're going to have to allocate a lot less capital to treasuries, so the market price for treasuries will be lower and the yield will be higher. My question is, why are you confident that banks will allocate their shrunken balance sheet towards commercial loans and consumer loans, industrial loans, and sort of the real economy stuff, rather than just buy treasuries? Doesn't that depend on the profitability of those loans? And doesn't that profitability of those loans depend on both consumer demand for loans, which, if you looked at Bank of America, it wasn't terribly high. Consumer demand, industrial and business loans demand was high, and also the economy. Like if the economy, if we enter a recession, will banks be will? I think banks will want to buy a lot more treasuries during a recession, right?
Well, I mean, so I think I hear this line a lot, and I think I would make a distinction between, let's say, real growth and nominal growth. I mean, a recession by definition is you have less output, or it's lower real growth, right? But if inflation is high, then you would still have nominal growth, and it may not make sense. I mean, rates would go higher, so you wouldn't buy treasuries betting that rates will go lower because you have inflation. There's this difference between nominal and real. But I think that banks are seeing more loan demand, and they seem to be wanting to hold more loans rather than treasuries. I think in the Eurozone, I mean, time-tested thing for banks to do is to just buy lots of sovereign debt, in part because they have to, because the government makes them do that. But it's also high yielding if you're in a periphery nation.
I'm gonna just a follow-up question, which is, what about the common equity tier ratios mandated by Basel? If they get to a certain threshold, wouldn't there be a level where they can't deploy any more capital to risk assets without buying safe stuff like reserves or treasuries?
So that's a different thing. So capital is a liability. So you'd have to issue more, let's say, equity or longer term debt. DC was actually just talking about this. It seems like banks are issuing a lot more, let's say, subordinated unsecured debt, which is like tier 2 capital, and maybe preferreds, potentially to have more balance sheet space. Is that what's happening, DC?
Yeah, I think we were talking earlier today. It was about the loss absorbing capacity, right? So the banks, and when you look at the assets versus the liabilities, right, there is a buffer of capital, but there's also some of the liabilities have the ability to be bailed in, right? So those are some subordinated bank bonds that in case that a bank did come under stress could be converted into equity, and that's there's a rule on that, the TLAC rule, the total loss absorbing capacity. And the banks need to maintain a certain percentage of their total assets and their risk-weighted assets as loss absorbing capacity. So if they start running low on that, they might need to issue more of those subordinated bonds, right? and I think a few of them have been doing that recently.
That could, in theory, give them more balance sheet to buy treasuries, to like Jack suggested. So maybe that is part of the plan. But ultimately, the people who run the system, they can rig it. So one thing they could do, of course, is just to exempt treasuries from their SLR, right? Then banks could just buy as much as they want. And, it seems like an easy fix.
Didn't they do that already? The SLR
Temporarily. But
temporarily, yeah.
it'd be very bad policy, but they could do it if they wanted to have a bid in the treasury market.
Yeah. Yes,
The-
DC, go ahead.
The other thing we were talking about the banks and the money market funds earlier, and the other thing with that is the banks and the money market funds, they compete with each other, right? So if the money market funds can offer higher yield than, say, a bank can offer on deposits, the deposits will go from one pocket to the other, right? And banks will lose reserves and money market funds will gain assets. So a lot of kind of the bank's balance sheet future depends on where they go and how competitive they are on deposit rates. And from what I've seen so far in Q1 guidance is most banks are fairly sure they're not going to move deposit rates for the first 4 hikes of the hiking cycle, roughly. After that, I don't think they know, honestly. I think they'll probably wait and see. But at least for the first 100 basis points of hiking, most of them are pretty confident that they'll keep deposit rates at 0. So we'll have to see how much people are willing to move their deposits away from banks to seek out alternatives. And that will also be a factor that determines what the banks can do.
So I think Bill Nelson, I believe he used to be the senior person at the Fed. He had a comment once, and I thought that was very interesting, that when the Fed raises rates, it could actually potentially make the RRP go higher, because if as you're mentioning, DC, that banks keep their interest rates at their deposit rates at 0, a lot of money goes out of the banks into the money funds and maybe into the RRP. And so you could have this weird scenario where everyone's thinking that QT is going to drain the RRP, when and the opposite happens, because the Fed is hiking rates, the RP becomes more attractive, money funds become more attractive, and so more money actually pours in. So it's not completely set in stone what will happen. I think it's unlikely because, well, I mean, that did not happen last time, but could.
We've got a comment from CG who says, "Sounds like bank stocks are going to get wrecked." I actually I was speaking to Chris Whalen. He's actually pretty bullish on the banks. And I think the deflationary view that I envisioned, there's no loan growth, they're all going to buy treasuries, that scenario is bearish for the banks. But I want to hear, Joseph, your end sounds like DC's too, where yields all across the yield curve go up and banks are buying fewer treasuries, they're making loans. Is that bearish for the banks, or is it not?
Well, I think DC has a few Twitter posts on his thesis on the financials, so I'll let him share that.
Yeah, I mean question about the banks, right, is the quality. Well, number one, the quality of their assets, and number two, how much income they're able to generate off of them. And the net interest margins that they're earning are still quite historically low. They collapsed during 2020, and some of them have come off the lows a little bit, but by historical standards, banks' net interest margins are still quite low. And part of one of the reasons for that is that, first of all, the banks have been flooded with deposits since 2020. Deposits have grown across the board by like 50%. So, and since there weren't really many high yielding opportunities during that time, much of that growth in deposits has been invested into fairly low yielding assets at the front end, right? Most bank net interest income is in relatively short term duration. People might have this conception that banks borrow short and lend long, but they don't actually lend that long. Maybe you can look at the average duration of bank portfolios. It's not very high, maybe 2-3 years, right? So the as rates rise, the margin is going to expand, but how much it expands really depends on how low they are able to keep deposit rates and still maintain very stable funding, right? So if you are bullish financials, you would believe that as short-term rates rise, the banks will start making more money off of that and continue to do that for longer than the market currently believes, right? So you probably believe that short-term rates will rise and stay higher for longer, right?
And just to emphasize your point that banks kind of lend short, I mean, like JP Morgan has a few $100 billion of just sitting in cash in the Fed. That's like ultra short. That's overnight lending, right? And all of that is going to go, the interest on that is going to go up 1-to-1 with every Fed hike. So if we're at, let's say, 300 basis points at year end, then that's 300 basis points more in interest income. And I mean, I agree with you that deposit rates probably won't go high very much. So that's just widening the NIM mechanically significantly too.
Yeah, I will say it does depend on the bank. For example, the example I like to give is in a year ago, in the first quarter of 2021, the net interest yield for Bank of America was 1.68%. And now that Treasury yields have risen, 200 basis points or higher, it's 1.69%. So it's gone up 1 basis point. So it does take a while for these things to kick in. And it does, as you said, DC, depend upon banks' ability to keep financing costs low. And it's interesting you said that banks are intending to do so. So that means if any viewers are out here, saying Fed funds rate is going to be 3%, therefore I'm going to get 3%, deposit rate on my checking savings account, you may have to wait a little bit longer.
I'm still zero. I've never been above zero ever, actually.
Yeah, me neither, actually.
The other thing there is that banks can be asset or liability sensitive, right? Nowadays, pretty much all of the banks are asset sensitive. Their rates rising is mostly a benefit to them since it increases the rates on their assets while not really increasing the rates on their deposits so much. But say if you look 20 years ago, it was much more of a mixed playing field in terms of which banks were liability sensitive or asset sensitive. Mm-hmm. And that has so that's been a change in the market also. It's not really a kind of something with that is historically always true that rates rising is good for bank margins, right?
Very interesting. I know we're running. Change. Sorry. Okay. Joseph, you go ahead.
That structural change is just the core behind my bullish financials thesis. It's because banks post Basel III don't fund in money markets, so their liability costs don't go higher anymore. They're all retail, basically stuck at zero. So I think that kind of fundamentally changes what happens to their profit, their NIMs when rates go higher. So I guess we'll see if that's true as rates go higher.
Right, NIMs, net interest margins. DC, I know we said it's going to be 40 minutes. Do you have more time to stay? If not, it's totally cool.
Sure, let's go.
All right, great. Let's put a chart up, which is yours, DC, which is the maturity profile of the Federal Reserve's balance sheets. Bills is in red, that is short-term paper, less than a year. Notes and bonds, regular treasuries, that's in blue. And then Treasury inflation protected securities and floating rate notes are in yellow. Explain why bills and floating rate securities are important and how that applies to what the Fed has indicated it wants for its quantitative tightening.
Yeah. So, okay, first of all, quick disclaimer on this chart. I made it in like 5 minutes in Excel, so I can't guarantee that it's 100% accurate. I'm fairly sure it is. And it just shows the distribution of the Fed's portfolio of treasuries by when they mature. So, for example, in this current month of April, we have about 120 billion in treasury securities maturing, and about half of them are bills. Now, the Fed currently is rolling all of those forward. So once they mature, they immediately try to buy as similar of a security as possible at a rollover in a rollover auction, and then the balance sheet continues as before. But once QT starts, they're saying they want to allow 60 billion a month to mature without reinvesting them. So unless they want to sell some of these treasury securities, they need to have at least 60 billion maturing per month. And ignoring for now the tips and floating rate notes, since those are a relatively small amount, if we look just at the notes and bonds, we see, for the most part, in most months, they do have about 60, but there are a few cases where they might need kind of 10 or 15 billion more. So the question there really is, if the Fed has, say, 40 billion maturing and 160, does it sell 10 billion more, or does it use the bills? Does it roll over some of the bills and use them to fill in the gaps where it can? Because the bills are very short term, so they can be rolled over basically monthly. And if necessary, the Fed could use those to kind of make sure it always has 60 billion maturing, or it could sell, or it could not worry about the 60 billion and just allow however much is maturing to mature. I don't think they'll do that last option. I think they'll most likely try to fill in the gaps by kind of playing with the bill rollovers. But happy to hear Joseph's take on that too.
No, I think that's exactly right. I think that was suggested in the minutes. So we're going to have $60 billion in treasuries roll off every single month. That's for the next 3 years. Whenever we don't have enough, I think we'll just plug it with bills, and that's fine. So they've always handled bills a little bit differently. The last QT, they didn't have bills roll off. This one is different. They have 330 billion. It looks like they're just going to use it by just plugging the gap, as DC suggested. So looks like treasuries are going to be pretty straightforward going for the next 3 years. Agency MBS might be a little bit different, but this one looks like it's going to be 60, solidly 60 for each month for going forward.
Yeah, so that plugging the hole with the bills would be in May 2022, the blue bar notes and bonds is well enough to have the $60 billion roll off. So they'll take some of that red on top, the bills on top of the blue, and move that to a month like, I don't know, October 2022, when they need the bills to hit that $60 billion bogey. So that's treasuries. That is enough of a challenge for the Federal Reserve. Let's now talk about mortgage-backed securities, because at least when you own a treasury, Joseph, at least when you own a 7-year treasury, DC, you know when it expires. You know what your interest rate risk is, and you can say, hey, this is going to expire in 2023, and it will all be good. However, the Federal Reserve also owns, I think, over $2 trillion worth of mortgage-backed securities, which are not like that. You can have a 5-year mortgage-backed security, suddenly mortgage rates increase, and then no one refinances their mortgage, and suddenly what you thought was a 5-year mortgage-backed security is now a 12-year mortgage-backed security. And that, if people connect the dots, that is going to be a huge problem for the Federal Reserve, which has repeatedly insisted that it will not sell its assets; it will let them roll over. How big of a problem is this, DC? Am I dramatizing things? Am I making mountain out of molehill?
Well, it's tricky, right? And I would say so really the problem comes down to, right, is like you said, when someone has a mortgage, you don't know when it's over, right? You don't know if they'll sell their house and then their mortgage matures basically upon them selling their house. If they'll refi their house, the mortgage is also matured at that point, and the Fed gets. If the Fed owns the mortgage-backed security, they would receive all the principal at that time. So when the Fed's MBS portfolio matures is kind of up in the air, depending on home sales and refis, which have both kind of started falling off from the peak. However, there's a question there, whether the Fed will be patient and will kind of wait until their portfolio matures on its own, or whether they will try to push it along and sell some MBS. And there's the fundamental issue there is it's a positive feedback loop there, right? It's self-reinforcing. If you sell mortgage-backed securities, that increases the yield on them, that discourages people from selling their house or refinancing them, and extends the duration out further. And extending the duration also increases the yield. So it's a self kind of propagating cycle. But where it's also might be actually better for the Fed is that because QT through the mortgage market has this kind of self-reinforcing effect, and because the mortgage market affects everyone and kind of affects everyone's wealth effect very tangibly, the mortgage market might mean that the Fed actually doesn't have to do as much if kind of the mortgage market tightens for the Fed, basically by extending the duration of mortgage-backed securities and raising mortgage rates and basically discouraging people from selling their house or refining, and especially refining, since refining, if you cash out refi, that is cash that goes directly into consumption, right?
Right. So the $35 billion per month, that's the hurdle that the Fed has set for themselves in the same way they've set a $60 billion hurdle for treasuries. So a total of $95 billion reduction of its balance sheet per month. Joseph?
So the New York Fed has this estimate that the mortgages will pay down about $25 billion a month going forward. So it looks like we're going to be short of that cap for the next few years. So I think that reserves the possibility. So they know this. Okay, so they know that it's estimated to pay down 25 billion, but they gave a 35 billion cap. That's probably to give them some leeway to sell if they want to. And so they've mentioned the possibility of selling. They probably won't get to it, at least for the first 2 years, but possibly they could if they wanted to. If for whatever reason they felt mortgage rates were too low or housing was on fire too much, then they could sell it, and maybe that'll have an impact. One thing you guys should keep in mind, though, is that one of the huge unintended consequences of this, and I first heard this from Joshua Hartman, who's a real estate analyst. Is that you have all these people who have very low mortgages. They're never going to sell. They're never going to sell because when they sell, they're going to lose that 2.5 mortgage, right? So you kind of structurally decrease the supply of housing simply because so many people refied or bought new homes, and if they sell or move somewhere else, they're going to lose that. So I think that's probably going to be some kind of unintended consequence going forward.
Joseph, correct me if I'm wrong. Did the previous quantitative tightening of 2017, 2018, did that involve any selling, or was that only rolling off? No. So the Federal Reserve has never sold a security other than it's like testing, sell $1 million here, sell $1 million there, right?
I mean, it's done operations, let's say, like Twist or something where they do. So they can, but just not for QT.
Right, okay. But the market is quite unfamiliar with the Federal Reserve calling the market up, and instead of buying, they're selling. That's quite a different experience.
For mortgages, I think, yeah.
Yeah. Okay. What do you guys think the effect of that is going to be? And then also, what about the fact that Chris Whalen said that some of these coupons are at a 2% coupon issued at $101. They're now trading at $89 at a $2 coupon, 2% coupon, and market makers, they don't even make markets in 2% coupons anymore. That's like kind of bringing a silver dollar to like a bank,
Yep. Fed is not that stupid. They just won't sell them. They'll sell better ones.
Yeah, I mean, you also have to keep in mind, right, that the Fed is willing to finance these securities, right, through the standing repo facility. The Fed will lend against these securities. So if someone has a mortgage-backed security they need to finance, they can post it at the Fed for some repo rate, and they can hold it there for a while, right?
Yeah. I wouldn't worry. Yeah, I don't worry about that. Okay. I still think the market will blow up before we even get that far. I don't know. So, DC, if we have stress in the Treasury market, I think you seem to share this view. How long do you think it would take? I mean, it's hard. I don't know. But I mean, if you have an idea,
yeah. And I mean, we've had a few scary moments in the Treasury market, right? Like last year in February, we had that one 7-year auction that went much worse than people thought, and the Treasury yields kind of went crazy for a little while. And we've had a few other moments like that, right? Where the Treasury market has kind of hit a bit of an air pocket. But
Like a 20-year, I think, yeah.
Yeah. I mean, so far it has not been as big of an air pocket as it was in March 2020. And in March 2020, that really had to do a lot with kind of hedge fund delevering and everything that was going on. And the Fed had to buy, what was it, 700 billion in securities very quickly to fill in that air pocket, right? And if something kind of similar to that happens again, I don't doubt that they'll do the same. But really, it's kind of a question of how much the market is able to withstand until it gets that bad. And there's reasons to be worried. There's also, I think, reasons to be hopeful. They're making moves with central clearing and with moving kind of all of repo trading and treasury clearing to FIC. So that will probably be good somewhat for stability. But yeah, if we do hit a kind of a really big air pocket, I do expect the Fed will be there and we'll have to support we'll have to be a dealer in the treasury market again, really.
DC, Joseph is of the view that yield on the 10-year treasury note could or may hit 4% by the end of the year. Are you in that camp, or are you higher or lower?
In that it could? Yeah, I think it definitely could. I mean, if the Bank of Japan does this thing that we were talking about, it could go up, I don't know, 30 basis points in a day. Like I would not be surprised at all to see that, right? So if we're kind of talking about big moves and talking about volatility and rates, I mean, I think we've definitely seen that already, and I don't see why it will stop. I think we're going to continue seeing that for a while, really.
I think that's probably the near-term catalyst, because I mean, I fully expect the BOJ to reevaluate its YCC ban. I mean, sometime in the coming weeks, or maybe coming months, but they have to, right? I mean, they just can't let the yen just implode like that. So there's going to be a limit, and that's probably going to be the first test. I don't know when they'll step in, but it looks like the yen is going parabolic, so maybe sooner than we think.
People are noticing in the comments that Netflix is down 25% after earnings. Not related to the plumbing, but it's just a reminder that these discount rates do matter. And the carnage we've seen in the 30-year Treasury yield. Maybe if the 30-year Treasury yield were still at 1.7%, Netflix would only be down 21%. I don't know. I don't know. I don't know anything.
Netflix is crazy like that. It's always up and down, up and down. But wow, that is kind of a big drop.
That is. It's a chunky.
Yeah.
DC. Yeah. The name of the show is Forward Guidance, and there is a news event today that we've got to talk about, which is Bullard expressed fondness for a 75 basis point interest rate hike, which would be the first one since 1994. He praised Alan Greenspan's decision to raise rates by 3/4, saying that it set up the U.S. economy for a stellar second half of the 1990s. How are you, DC? How are you thinking about a triple rate hike? Is that in the cards, or is it something that's sort of just a news thing that he's saying to have the market tighten itself so the Fed doesn't have to do a triple rate hike?
Well, I mean, I personally don't think that triple rate hike will happen in reality, but it is a thing in the market's pricing, right? And the market has priced in for the next two meetings, so the May meeting and the June meeting, has priced in about a 50 basis point hike, more or less as a sure thing, right? But at that point, it really becomes a question of if you're pricing 25, 50, or 50, or if you're pricing 50 or 75, right? If you take 25 completely out of the equation, and even if you don't think 75 is going to happen, if there is a Fed governor talking about it, you kind of have to hedge against that possibility. So if the market shifts from pricing 25 to 50 to pricing 50 to 75, that is an incremental kind of tightening effect. And we saw it today. I mean, if you look at interest rate futures, the kind of Eurodollar white sold off, and Fed funds and everything got hit because Bullard said that. So it does have kind of an immediate pricing effect on the market, right?
We're going to levels that are approaching like 2018 Q4, but it doesn't seem like the equity market. I mean, it's coming down, but it still seems surprisingly resilient. Do you have any thoughts on why that might be, DC? Because I mean, the last time we were like this, it basically melted down in Q4 of 2018, but it's still going down, trending lower, but there does seem to be a bid.
Yeah, I mean, the one thing I'll say, and maybe this is very optimistic, is there are a lot of issues in the world, but real growth has been very strong in this recovery. If you look at the kind of U.S. real GDP trend, we are almost, or if you might even say completely back to 2008 to 2019 trend within kind of 2 years into the recovery, right? So, I mean, yeah, you could say equities should be down more based on kind of how much headwind they're facing and kind of all the uncertainty in the markets, but also maybe that's a testament to the fact that the economy is recovered better than what many people would have thought, despite all of this.
Yeah, I can't offer any explanation for it, Joseph, but I just want to draw attention to that fact and underscore it, which is that risk premia for risk assets like equities and credit have not they have not tightened that much. So much of the destruction we see in the markets, like if you look at HYG, a high yield ETF, it's down 7% year to date. So much of that is purely interest rate component and has nothing to do with credit spreads. High yield credit spreads are within a few points of record tights. So I think it's not just the equity market. I think it's the credit market, investment grade market. Either the interest rate futures market is way too hawkish and way too aggressive, or the credit market and the equities are I think too comfortable. I don't know which is which, but I know there's a disconnect there.
Yeah, that's a good point.
Yeah.
I wonder if just looking at the dollar strength, and we just have a lot of foreign capital just flooding here as a global safe haven. So
yeah, I mean that's also probably a factor, right? And there's U.S. equities are owned all over the world, right? And they're maybe not great, but where's the better place to be now?
yeah, I guess we'll find out when we have more tick data going forward in the coming months.
Right. Well, I was going to say, DC, 6 months ago, the better place to be would be Europe, but I don't think that's the case anymore. DC, thank you so much for coming on Forward Guidance. I'm really glad that the audience got a chance to meet you, hear your analysis. You are a very sharp guy, and you really know what you're talking about. And Joseph, thank you for recommending DC and being my co-host, as always.
For you guys, this is the first ever face review of DC, so voila.
Yes.
I appreciate it a lot. It was a lot of fun. I'm definitely down to do it again if you guys want to. And yeah, thanks so much.
Thanks for coming on, DC.
Thanks so much, guys, and thank you for everyone for watching.
Make sure to follow DC, follow Jack, and FedGuy.com.
Follow at FedGuy, FedGuy.com, and subscribe to the Blockworks YouTube channel. Thank you so much.
All right. Cheers, everyone.